In this next segment, we're looking into retail stocks for the half year with particular focus on Foschini Group, Mr. Price, Pepkor, as well. Naspers is Takealot, South Africa's biggest online retailer that posted a loss of 400 million rand yesterday. Joining me for that conversation is our favorite ghost, the one and only finance ghost. Thank you so much for joining us. So let's dive into it. Foschini Group, I mean, in this environment, it really looks like they're playing a balancing act. Looking at the last 6 months, it has been a story of them basically running promotions that are in order to keep the consumer, because the consumer is under pressure, and there's a whole load of other headwinds. But that promotional activity is eating away at gross margin. So it really has been a tough period for them. They're down. Their share price is down 12% in the half year. Run us through your analysis on this stock in particular.
Hi, Tania. Nice to be back. Your favorite ghost and your only ghost, I think. But yeah, TFG is facing a whole lot of pressure on gross margin. And it's pretty simple, right? Just imagine as a consumer, we were all keen to have a good festive season. Eskom decided that was too much like a good time, and they ruined that party quite badly. Then everyone panics and they go, oh, might not get my bonus next year. What should I do with my money? They save a bit. They don't go to the malls. And guess what? Those shelves that are nice and full of stock that was bought in for what was supposed to be a very good festive season, actually that doesn't work out, right? So now you have retailers who are sitting with seasonal product on their shelves and they need to do something about it. So what do? They go and put the stuff on promotion, right? I mean, what choice do they have? They can't sit with this stuff for the entire season. Clothing retail is fascinating. So much of your gross margin is all about what percentage of your goods on the shelf you manage to get away at full price. And all of us know, end of season sale, 50% off. They're still making money on that, by the way, not a lot. And by the end of the season, they're really giving the stuff away almost at cost. So, we saw pressure on sales. We saw pressure on gross margin that went the wrong way. They did at least manage to keep their trading expenses at a steady percentage of turnover. So what that means in simple terms is the actual store expenses were pretty well controlled. This was very much a gross margin problem. And that gross margin problem just gets worse the more you look down the income statement, and eventually you get to headline earnings per share, which fell by 4%. The final dividend is way down, and unfortunately, that's not just because of gross margin. That has got to do with the debt that they took on board to do some pretty big acquisitions.
Yeah, namely the Tapestry and so forth. But looking at another one that has done quite a few, an acquisition in recent times, actually, Mr. Price Group, with their acquisition of Studio 88. Now, their share price is down as 10% in the 6 months to date. Yeah, we're seeing a slightly different story, but kind of similar. Your take on this one?
Yeah, so Mr. Price, it's a bit like Formula One, right? It's lights out and away we go. And away we went to the other stores in the mall who actually bothered to have backup energy. It's very cheeky, but unfortunately, I'm not wrong. The problem with Mr. Price, and they've had some pretty colorful reasons why they didn't have enough backup energy, including calling themselves a value retailer, which is just pathetic, to be completely honest with you. I mean, must we sell cheap clothes in the dark? We can see how well that worked out. So nonsense aside, the reality is that I think they've been too busy with acquisitions. They've taken their eyes off the core business, and unfortunately, you just cannot do that in a situation like this. The other thing that's interesting with Mr. Price is, it's traditionally a very cash-strong business, and I see it's on the screen now. Cash sales were only up 1.2%, credit up 8.3%. So there's an affordability problem here, even in the value end of the market, and that is a concern because, again, that talks to ongoing pressure on gross margins. How are they going to get all their inventory out of the door if they can't do it at decent prices? And they can't do it at decent prices, firstly, if they don't have backup energy, although obviously load shedding has calmed down a lot, but secondly, if they just can't sell to people because they can't afford the stuff.
Yeah, indeed. And Pepkor, another one. Now, this one slashed by quite a bit, feeling the pressure, down 20% in the 6 months to date. And I mean, looking at this story, we saw Ackermans was quite a big issue. Yeah, quite a bit of inventory that they're holding on to. What are you making of this stock?
So again, it's a perfect example that even if you're a value retailer, and people do this all the time, they go, okay, consumers are struggling, I must own a value retailer. And that's great if the value retailer is performing. None of these things are a silver bullet, right? And a luxury business can be the best thing to own in tough times because those people are not necessarily feeling the pain. So The point at Pepkor, it seems like they got some of their inventory strategy wrong in Ackermans. That caused a pretty big drop in sales. Unfortunately, guess what? Inventory is higher. And I haven't mentioned it on either of the other two yet, but the problem when your inventory is too high, it means your working capital is too high. So too much of your cash, the profits you did make, is actually getting caught up in just keeping the stock on the shelves. And of course, money is not free right now. In fact, it's very far from free. I know your previous guest was talking about, potential further rate hikes this year. Money is expensive right now, and these companies cannot afford to have working capital just sitting on the shelf and not actually making them a return. And the one thing I want to highlight on Pepkor, because it's astonishing, it's similar trend to Mr. Price in terms of cash versus credit, but actually way more pronounced. So cash sales were up 2.5% roughly, credit sales up more than 36%. That is a huge difference. At least in Pepkor, there is one piece of good news there, which is that the Avenida business that they bought in Brazil, that's actually running ahead of expectations. So interestingly enough, their peer group has been doing deals locally, very much a proudly South African vibe. Pepkor actually rolled the dice in South America, and we know how badly South African retailers have historically done offshore. But I think South America is pretty interesting. I haven't traveled there myself, unfortunately, but I can understand reasons why it might be more similar to the South African market than, say, Australia or the UK high street. So far, so good for Pepkor in that market, and we'll see how the Avenida acquisition progresses.
And so your pick of the three then, if you had to make a pick?
Well, that's a good question. I mean, do I have to choose one? I wouldn't own any of them. Honestly, I wouldn't own any of them in this environment. I don't think we're done. I don't think that load shedding is the primary reason for the pain. Load shedding's been a much bigger issue in the grocery retailers, right? Because they have a cold chain. So I think load shedding falling away really helps the grocery retailers a lot because they're not burning as much money, literally just keeping the lights on and keeping the food cold. Clothing retail is an affordability problem. It's a cost of credit problem. It's a working capital issue at the moment. TFG would be my last of the three, if I can pick a worst, despite the Mr. Price management team's recent performance. And that's just because they have so much debt now. They've gone and done the acquisition of Tapestry, which is big consumer durables, it's couches, it's that kind of stuff. And they've got a lot of debt now. It just feels to me like a risky play at this point in the cycle.
What about online? I mean, Takealot?
Or take a loss, as I called it in Ghost Mail this morning. That's all they seem to be able to do, unfortunately. Look, I mean, I've been pretty vocal about Naspers and Prosus this week, and the reality is that this thing is funded by the Naspers balance sheet, which practically knows no bounds. It's almost unfair competition, if I can be that cheeky, because what they're actually doing is really hurting retailers who don't have the luxury of running at a loss year after year after year and just sweeping it under the carpet like no one cares, No one else gets to do that. So Takealot really hurt a business like Massmart, for example. Let's not cry over Massmart, which also had a proper balance sheet, and Walmart as a controlling shareholder. It's hardly a mom and pop store. And the reality is the consumer does win here, which is what should happen in a capitalist market. That is what should happen. But you just wonder, is Takealot ever going to make money, right? I mean, what happens if Amazon comes into this country? What happens there? But the biggest thing I think we can learn from Takealot is pure e-commerce doesn't actually work. Omni-channel is what works. You need to have proper sites where people can view the stuff or at least pick it up. And that's mainly because courier companies, we know how irritating it is. It's easy when everyone stayed home, but now when you're at work, it's not so easy to be there for a delivery or whatever the case may be. And maybe that's good news for the retailers who have a store footprint. I'm thinking of something like Yuppie Chef, for example, which was acquired by Mr. Price, a business that famously started online, but really only started working out when they actually opened dedicated stores. Even with a small store footprint, it just gave it that, that credence. There's a real thing. You can see and touch it. So with Takealot, I just ask myself, if they couldn't make money in the pandemic with low interest rates and everyone's sitting at home waiting for deliveries, under what conditions are they ever going to actually make a profit?
Yeah, and speaking of omni-channel, I mean, one of the things that we did see in Foschini Group's latest statement is Bash, actually, their online outlet, which combines all of their brands, contributing 9.1% of the group's total turnover. So what are your thoughts on some of these companies' online representation?
Yeah, so Bash is, that's exactly right. And look, clothing, it works a bit better because you've got high margins. So that what they have to deal with in clothing, I've had this conversation. I was lucky enough to chat to Roy Bagatini at one point, who's the chief exec at Woolworths, obviously. And, we were talking about how in the clothing side, obviously, clothing has much bigger gross margin. So it just gives you a bit more room for error in terms of people returning stuff, etc. Food is a lot harder. So I've spent some time in food retail before, and The reality is that you need a pretty big basket size for the food retailers to actually make money from on demand. A lot of it has really been quite defensive in terms of market share. And obviously, we know what the likes of Checkers have achieved with 60/60. I guess that's kind of the standard bearer. Online can be a little bit of a red herring, but the problem is retailers have no choice. And that maybe goes back to my point where I'm quite careful with which retailers I invest in because consumers can just vote so easily with their feet. I mean, we win, right? All of us win at the end of the day. Omni-channel, competition, promotions, we're all smiling. But the retailers are not because they have to be everywhere all the time. They have to have this expensive footprint. They have to have energy backup. They have to have big warehouses that can do proper fulfillment. And people want same day delivery or easy returns. I mean, you can just imagine, right? It adds up very quickly. So for me, the net winner from online is actually the consumer. Retailers, they have to do it, but they would all prefer it, if they are very honest, if you actually went into the store and bought your stuff there.
Which is interesting, considering the costs associated with running a physical outlet, and especially in this economy where we have load shedding, where the cost of fuel is going up. That you're saying that companies would prefer for us to go in store. I mean, why?
Yes, it's something I've thought about a lot, right? But the reality is that on these delivery charges, you'll often have a scenario where the retailer is basically subsidizing that a little bit. So it depends on the basket size. But just imagine now you go onto Checkers, right? Yes, you pay for a delivery. There is a delivery charge, but it's a modest fee. You know, and I know it costs more to get in your car. I mean, they've released this report, right? I think they did a whole marketing thing at one point to say the AA told them and confirmed it costs more to drive to the store and back and pay the security guard $5 and pay for parking than it does to just sit at home and pay your 35 Rand or whatever that fee is. So the problem is, imagine subsidizing the travel cost of every single person who used to come to your store. There is a point, there's an inflection point at which it's cheaper to just own the store and let people come to you than it is to not have the store and subsidize everyone's travel. And the problem for retail is it's not either or. They need both. So they still have to have the store and they still have to be prepared to subsidize getting the stuff to you. It's very, very interesting. And if they try ramp up their delivery fees, someone else comes in backed by venture capital money or a corporate balance sheet looking for market share. And guess what? They just bring that cost down again. And so the consumer continues to win. It really is a remarkable tug of war, actually. It's something I enjoy following quite closely. And yeah, not all is not always what it seems when people start talking about online. You'll notice. When last did you ever see a retailer tell you how much money they make from online in terms of profit? They only ever say percentage of turnover, right? I don't think I've ever seen one say what the true profitability of online looks like.
Yeah, and I can tell you actually, because I was looking specifically for profitability when it came to Foschini's bash, and I couldn't find it. So that's a very, very good point.
No, you won't.
Yeah.
No, you won't.
So all in all, I mean, all things considered then, you've told us your worst would be Foschini. Looking at the retailers in general, would you actually in this climate invest in retail at all?
So I firmly believe that the local retailers are trading stocks. I think you can swing trade them. I mean, we saw that when the lights came back on and SA Inc. was suddenly rallying like crazy. If load shedding comes back, I think you could quite realistically go short on retail and you'd probably make some money. So I see them as mainly trading stocks, to be honest with you, because of all the challenges we face in South Africa. I mean, you could just list them top to bottom, right? Low growth environment, high levels of competition, a very advanced sort of consumer. I mean, our retail is world class, right? Which is great for consumers. Utility costs through the roof, security, the list goes on and on and on and on. And the problem is the likes of ShopRite inevitably are trading at very high multiples. So I actually wrote something recently, I think it was for FM, and it was basically about how in this environment, actually a B2B business works out better than B2C. And what by that I mean an industrials play like Invicta or Bidvest. You know, they're just not facing the same kind of issues. They're managing to make money in inflation. A lot of the retailers in a time of inflation, they actually get squeezed. There's a point at which inflation is too high and it hurts them. Too low also hurts them, by the way. Yeah. They kind of need it in the middle, and they need it in a relatively low interest rate environment. And at the end of the day, if you go draw a 5-year chart on all of these retailers, you will find that you would have been disappointed on pretty much all of them. Your money would have been better off just sitting there earning interest. So great trading stocks for those who enjoy watching technical levels and swing trading. Investing, not really.
Oh, all right. I'm glad I asked you that question, and I'm glad you joined us today. Thank you so much, a finance ghost of, well, a market analyst. Thank you. Always a pleasure chatting to you.